Hello guys, welcome into the channel. If you haven't subscribed already, please make sure that you subscribe. Please make sure that you also like the video and then share with the rest of your friends. In this video, we are going to be covering accounting grade 11 November 2024 paper. So we're just going to be starting with question one, but look out for the playlist in the description to then get question two and the rest of the other questions. Please also make sure that if you're looking for notes to these, you can simply click the link in the description, fill in the details, and then you will get an email that contains all the notes that we're going to be covering in this. All right, without further more to do, let's jump straight into the question. Okay, so starting with question one. So question one is on fixed assets as well as the internal controls. So the first question that we got here in question one is calculate the denoted figures number 1 to 4 in the fixed asset note. Then we got the rest of these questions here. Carefully look close that this is basically the denoted numbers. Now, one thing that I always do when I look at my past papers is that I always make sure that I have an answer book. The answer book is just to make sure that in case maybe some of the information is actually covered in the answer book, that I can use it. But I can see in this case, there's really no information that comes from the answer book, so I won't be using it. It was just to check. Otherwise, I'm going to be answering the questions in this sheet over here. And we're going to be figuring things out as we go. So please make sure that you're paying careful attention so that as I'm explaining, you can also start to grasp some of these things. It will also possibly be beneficial for you to just print out that paper when you watch. But if you haven't printed, I don't think that it's a big strain smash. You can still be able to hear what I have to say. All right, cool. So let's start then working out. So we're looking for number one, number two, number three, and then number four. Okay, cool. So number one is looking for the cost of land and buildings at the start of the year. So let's see. So we're given this information, and I want us to just quickly look at the information below, and then after that we will then move on to answer those questions. So we have depreciation, which doesn't affect land and buildings, but you know that it's 10% on the diminishing balance method for equipment, and then 12% on costs for vehicles. And then new equipment was purchased on 1 July, no equipment was sold, no land and buildings were sold during the year. A delivery vehicle was sold for 115,000 cash on 31 December 2023. All right. That's fine. And then details in the asset register. This is what we've been given about this particular vehicle. All right. So we can see no information much is changing anything about the land, but we can basically use our common sense because if you look at the cost at the end, it is 4 million. And then we are looking for the cost at the beginning. So the difference between the cost at the end and the cost at the beginning would be if there was maybe some land and buildings that were sold, and then also maybe if there was some land and buildings that was bought. In this case, we have additions at cost in respect to land and buildings. So in this case, we actually added to our land and buildings. So before we added, how much was it? So that when we add, it adds up to 4 million. So that would be a simple calculation of saying, well, for the land and buildings, we're going to say it's 4 million minus the 750,000. So that will give us the balance at the beginning. So the balance at the beginning is 3,250,000. Okay, so that's answering number one. And then let's move to answer number two. So number two is here, and number two is basically what? Number two is the carrying value at the beginning of the year. And to work out the carrying value at the beginning of the year, we'll take the cost, we subtract the accumulated depreciation. So that's fairly straightforward because we got both those things. So then in that case, we would need to say, well, the 600,000 minus the 180,000. So we're going to say there 600,000 minus 180,000. And so That would give us an amount of 4 million, sorry, not 4 million, 420,000. All right, cool. And then now we move into the next one, which is depreciation for the year. Okay. So when it comes to the depreciation for the year, this relates to the depreciation of equipment for the year. Now, when we ever calculate depreciation in these cases, we always want to make sure that we basically present our assets in different sorts of classes so that we make sure that we leave out nothing. So we would basically class it then to, well, old equipment. And this is something you do for vehicles as well. And then we have new equipment. And then we have disposed equipment. Okay, now old equipment, this means that this is equipment that was here from beginning to end. So it was here from beginning to end. Whereas new equipment means that it was brought in during the year. So I'll say DTY. All right, and then disposed equipment available at beginning and then disposed. Now, there's many ways to dispose an asset. You can sell it, you can donate it, it can be damaged, whatever the disposal method is. Basically, it was there at the beginning and then it got disposed. Now, if we look at our equipment, we can see that will only have two of these classes in this case because we don't have any disposed equipment. As the information also says, it says new equipment was purchased 1 July 23, and then it says no equipment was sold. So that means that what we need to do is to calculate depreciation on the equipment that was there at the beginning of the year till the end of the year. And if there was no equipment that was sold or disposed, then that means that the equipment that was there at the beginning pretty much carried through till the end of the year. It was there. Now, how do we work that out for the old equipment? Well, let's look at the method. So it says 10% on the diminishing balance method, and you know the diminishing balance method, right? So when you start with the old equipment, we're going to say the cost of the old equipment minus the accumulated depreciation, which is basically the 600,000 minus the 180,000 will give us 420,000, and then we work out 10% of that, and then we apportion, but in this case it's 12 over 12 months. So let's put that into action then. So we already know that the 600,000 minus 180,000 is 420,000. So then in this case, we can just go 420,000 multiplied by 10% and then multiplied by 12 over 12. Okay, and then after that, you're going to add. Now we're going to add for the equipment that was brought in during the year. So the equipment that was brought in during the year had a cost of 90,000. At the time that it is being brought in, it cannot possibly have accumulated depreciation, right? So the cost minus accumulated depreciation would be the 90,000 that it was bought for minus zero at the time. And then since it's going to be 90,000, we then would multiply by 10%. But in this case, we have to acknowledge that there would be an apportionment for the months that the equipment was in the business. Now, let's look when this equipment was brought into the business. It was on the 1st of July 2023. And so, until the end of the current year, which is 29 February 2024, how many months would we need to depreciate this equipment for? Well, we would need to depreciate it for July, August, September, October, November, December, January, February. So that's basically what? That's 8 months. So if we're doing it for 8 months, then we're going to then say, well, 90,000 times 10%, and then we depreciate it for 8 of 12 months. And then we can be able to then work out the answer there. And the answer is 48,000, and that represents our depreciation for the year as it relates to equipment. All right, cool. Now, the next thing that we are going to be looking at is when it comes to the vehicles, and specifically what we want to calculate is the disposals. at carrying value. So in other words, we want to know what was the carrying value of the vehicle at the date of its disposal. So firstly, we need to determine then its date of disposal. Now the date of its disposal is 31 December 2023, so still within the current financial year. All right. And so this vehicle, again, it would have been here at the beginning of the year until 31 December 2023. So we would depreciate it from the start of the year up until 31 December 2023 as we're trying to work out the carrying value. So to work out the carrying value, what we know is that when we work out the carrying value, so for the disposals at carrying value, because we need the carrying value, we will need the cost of this vehicle, and then we'll also need its accumulated depreciation. Now, its accumulated depreciation, you may think that it is given in this information, but it is not given, because what are we given? We're only given the accumulated depreciation on this vehicle at the start of the year, right? So then we need to figure out, well, we have at the start of the year, we then would need to work out the current year's depreciation in order to make sure that that balance, we're getting accumulated depreciation on the 31st of December 2023. All right, cool. So how do we work this out? Well, the important thing here that we need to figure out is what is our depreciation method? It's quite clear that it's at cost. So we then would need to find the cost of this particular vehicle. Now, how do we find the cost of this particular vehicle? Well, we have to think about how it works with vehicles at cost. So what I mean by how it works with vehicles at cost. So vehicles at cost, we can think of it like this. So we're going to say vehicles at cost, and then we're going to have balance at beginning, right? And then we're going to add new vehicles, right? And you are adding these vehicles at cost. So we're doing everything at cost here. And then we're going to say less disposed vehicles. Now, this would also be at cost. So whatever the cost of that disposed vehicle is, it would be applicable in this case. And then that will give us the cost of vehicles at the end. Okay, so let's fill in then this information. So vehicles at cost, the balance of that at the beginning. So the balance at the beginning of these fixed vehicles is the cost is 680,000 at the beginning, right? So it's 680,000. Then we have add new vehicles at cost. There is new vehicles because there's additions at cost. So we bought new vehicles for 120,000, right? And then after that, we're going to say, well, subtract the disposed vehicle, which is basically the question in this case. What is the amount of vehicles? What is the cost of the vehicle that was disposed? So that remains a question mark. And then we look at the cost at the end for vehicles. So the cost at the end for vehicles, as you can see there, it's given, it's 440,000. So it's 440,000. Okay. So then the disposed vehicle in this case, we can basically work backwards, because we're going to say 440,000. Then we're going to subtract the 120,000, and then we subtract the 680,000, and then that's how we're going to get that. So we're going to say 440,000. Then you're going to say subtract 120,000, and then we're going to subtract the 680,000, which gives us that balancing figure that the vehicle that was disposed was actually had a cost of 360,000. Okay, cool. So now in our calculation for the carrying value of the disposed vehicle, we at least have one more thing, that we got that this vehicle had a cost of 360,000. Then the next thing is to work out the accumulated depreciation. Now we know that in this accumulated depreciation, we already have a 215,000, right? And then we need to work out the current year's depreciation on this vehicle. So current year depreciation on disposed vehicle. Okay, so we know that we are using the diminishing balance method. So the diminishing balance method, sorry, we're not using the diminishing balance method, but we're using the cost method. So we want to take our cost, which is 440,000, then we want to multiply by 12%, right? And then we're going to multiply by apportioning the months that this vehicle was in the business. Now we know that it was disposed on 31 December 2023, so then we would start counting from the 1st of March right to 31 December of 2023. That is 10 months, but to confirm it, that's March, because we start in March, April, May, June, July, August, September, October, November, December. So that's 10 months. So we then would apportion by 10 months. So we're going to say multiplied by 10, then divided by 12. So what does that give us? Well, it gives us the current year's depreciation to be 44,000. Okay. So then as it is 44,000, we would then come on in here and say 215,000, which was the accumulated depreciation at the beginning of the year, plus the current year's depreciation, which will then give us the accumulated depreciation on the date of the sale. So on the date of the sale, the accumulated depreciation was 259,000. And so that would mean then that for our disposals at carrying value would have 360,000 minus 259,000. That would be 101,000. So I'll come show the working year. 360,000 minus 259,000, that gives us 101,000, which would be the amount for the disposals at carrying value. And so that would answer the first question here, which is calculating from 1 to 4. The next thing that we want to then work out is to work out or do a prepare the asset disposal account. So asset disposal account. So please make sure that you listen to me very carefully here, because I'm sure if you listen to me on this one, you will be good in this forever. Okay, so asset disposal, let us make, I'm just going to do it in a T account. As you can see in the answer book, there's, all sorts of columns and folio and stuff like that. I'll just, everything in the folio, because a lot of these things, when we're doing an asset disposal, they basically go to the general journal. So if you say general journal for the most things, you're good to go, except maybe where it affects bank. Where it affects bank, for example, if we sold this vehicle for cash, then in that case, would have bank, and then that would be CRJ, and that would be our folio column. Let's see how it was sold, actually. Was sold for cash, so yes, that's CRJ. Okay, cool. So let's start with the asset disposal. Now, the way in which we do asset disposal is that we do it in steps. And I'm going to go through each of these steps as I'm doing it. So, step one is you need to transfer cost of asset disposed to asset disposal. Now, how do you do that? Well, you do that by, we would debit asset disposal, and then in this case, we would credit vehicles, because we sold vehicles. And it makes sense to credit vehicles, right? Because vehicles is an asset, and assets will decrease on the credit side. So we're going to go here and have asset disposal. So then this, in terms of the date, Well, the date would be on the date of sale, so that is 31 December 2023, and that's pretty much the date for everything else, right? And then we're going to have vehicles and our details, and then our folio reference would just be general journal, so just GJ. So now the cost of this vehicle, we worked it out when we're doing the previous question, that the cost of this vehicle is in fact 360,000. And then step 2 is transfer of accumulated depreciation. Bear in mind that it needs to be updated. So, in other words, the 215,000 that is given here, you can see that it is given on 1 March 2023. So by updating, it means that we need to find this accumulated depreciation balance, what it would have been on the date of sale, which is 31 December 2023. Now, I've already done that in the previous question because we managed to figure out that the accumulated depreciation is 259,000. So we transfer that to asset disposal. And how do we do this? Well, in this case, we're going to debit the accumulated depreciation, and then we're going to credit asset disposal. Okay, so then in this case, you'll see that you're going to have accumulated depreciation on vehicles. You can see that I just wrote in short words, but when you're doing an exam, just please make sure that you write things in full. All right, and that accumulated depreciation is 259,000. Okay, cool. Now, the next thing that we're going to be looking at is the third step. So the third step is, transfer nature of sale to asset disposal. Now, the nature of sale, it really does depend because there's many natures of sale. You can sell it for cash, you can sell it on credit, you can donate it, you can give it, whatever the case is. In this case, the nature of sale is cash. So as it is cash, well, we would basically what? We would debit bank. If it was on credit, we would do debtors. If it was a trade-in, we would do creditors. If it was donated, we would do donations, whatever the case is. And then we'll credit now what it has been sold for. So, and then we will credit asset disposal, and it has been sold for a specific amount. So now you can see that, again, we're on the credit side of asset disposal. So in this case, what is applicable would be bank, all right? And so that bank would be the amount that we received. So in this case, we received 115,000. So 115,000. Okay, cool. So that's step 3, and then step 4. Step 4 is transfer profit or loss on sale of asset to asset disposal. Now, here the entries are a bit different. So if you have a profit, if it's a profit, we debit asset disposal and credit the profit on sale of asset. But if it is a loss, remember that when we get profit, obviously profits are our incomes, and our incomes increase owner's equity, and owner's equity increases on the credit side. So now, but if it is a loss now, well, losses are part of owner's equity, but the expenses, so when expenses increase, they decrease owner's equity, hence we then debit them. So loss on sale of asset, if we made a loss, and then credit asset disposal. Okay, now whether it's a profit or loss, well, if profit, let's make sure that we clarify how a profit is possible. A profit is possible if the selling price of that vehicle is greater than the carrying value. Loss if I'm going to take this same thing, I'll just change a few things. So if it is a loss, then your selling price would have to be less than the carrying value. So now in this case, if you think about it, we actually worked out the carrying value in the first question is number 4. So our carrying value, we'll take it from the first question that, well, the carrying value was 101,000. And what was the selling price? The selling price is 115,000. So in that case, then you can see that we sold a vehicle which was worth 101,000 and we sold it for 115,000. So that means then that there's a profit, which would be the difference between 115 and 101,000. So the profit there in that case would actually be 14,000. And so how do we record a profit? There we go with the profit. We debit asset disposal, profit and sale of assets. So since we're debiting asset disposal, we'd come into the debit side of asset disposal and have profit on sale of asset. All right, and that's going to be 14,000. Okay, and so pretty much then that needs to basically balance after we have done that. Let's see if it does. So you're going to add up each of these sides. So side 1 is 360,000 plus 14,000, which is 374,000, and then the other side, well, we also have 374,000 as we add 259,000 plus 115,000. So that would be what we basically just need to do as it relates to the asset disposal. All right, cool. So I hope that is clear. And now I want us to then look at the last few questions that are coming from here. So it says calculate the percentage increase in the value of land and buildings if the market value amounts to 5 million. Calculate the percentage increase in the value of land and buildings if their market value as at 29 February 2024 amounts to 5,500,000. Okay, so remember now that when we do this note for land and buildings and all of that, we're taking into account the cost. So we have basically land and buildings that have cost us 4 million, and we're being told that, well, there is a chance. What if these land and buildings that we got that cost us 4 million are now worth 5.5 million? What would be the percentage increase at that point? So percentage increase, the easiest way to calculate a percentage increase. So this is 1.3. So let's just make it clear that this is 1.1, 1.2, and then 1.3. So whenever we do the percentage change, whenever we work out the percentage change, we basically say, well, the new value minus the old value, right? So we have the new value minus the old value, and then we then would divide by the old value. Sorry about that. So old value divide by the old value, and then we multiply by 100. Okay, so let's do that then. So we're going to say, well, The new value in this case is going to be 5,500,000, right? Because we're imagining a scenario where the value of the land and buildings that cost us 4 million being worth 5.5 million now. What would be the percentage change there? So we're going to say 5.5 million minus 4 million, right? And then we're going to say, well, divide that by the old value, which is the 4 million. And then, take all of that multiplied by 100. That will then give you the percentage change of 37.5%. So that would be the percentage increase in the value of land and buildings if the land and buildings that we have a cost of 4 million, but now the market value. Because remember, with property, even though you can see that in this note here, we're recording things at cost. The market value is basically, well, if we were to sell this land and buildings, well, how much would we need to sell it for? So that is what a market value is. All right, so that answers our question. And then the last question that we have to look at is 1.4, where it says the owner notices the mileage on one of the vehicles extremely high. He therefore concluded that the driver is misusing the vehicle, such as two internal control measures that can be implemented to safeguard the business against the misuse. Against the misuse of vehicles. Okay, so to guard against, so this is one of those questions where if you say, a relevant point, something that makes sense, you will be able to get the marks. Now, make some suggestions, but you can perfectly have something else that makes sense. So, one of the things that I would point out is that the employees must keep a log of their business travel they do, because these are work vehicles. So if someone, for example, let's say, this business, we didn't discuss what type of business it is, but let's say, you're a delivery driver. So if you had to make certain deliveries, log those deliveries along with the kilometers traveled, and then those kilometers would basically have to be matched against the odometer in the vehicle so that things add up. All right. And then secondly, hire a supervisor that will track the kilometers in the vehicle versus the assigned business trips to each driver. All right, so that's another thing. What other things, for example, will be putting a tracker. I'm going to make an example, putting a tracker to know where the vehicle is traveling to. So you want to have that tracker so that if maybe you find in the tracker that this was not authorized business travel, then there may be consequences for that particular employee. Another one maybe could be ensuring that you assign a particular vehicle to one particular worker. In that case, it kind of just makes sure that that one person is being held responsible and there's no mix-ups that are happening. So that pretty much concludes question 1. So please do tune in on the next video where we are covering question 2 of this very same paper, or you can actually find that if you're checking the playlist below. And yes, so please make sure that you subscribe, like the video, share with the rest of your friends, and I shall see you on the next one. So cheers for now.